Not more positive economic news. Don't you know that we've robbed the millennials of their childhood and we're facing mass extinction all over humankind and species? Let's read this from a man over at First Trust Advisors, ftportfolios.com. This is from Westbury and Bob Stein. Dateline, I think it was just on Friday. What was the date on this? Friday, September 27th. Personal income rose by 0.4% in August. And we got personal consumption expenditures year over year, real personal consumption expenditures year over year, which takes into consideration inflation. All right, so let's read this. Implications. Paychecks continued to rise at a strong pace in August while spending growth downshifted following a surge in July. Personal income rose 0.4% in August, while income after taxes rose an even faster 0.5%, which is phenomenal. And incomes would have been higher in July, except for a 0.6% decline in interest income that partially offset rising wages and salaries from the private sector. So as the low interest rates, that does have an effect on income consumption for sure, because people aren't getting enough in interest. And I don't think that's going to change. Spending, meanwhile, rose 0.1% in August and is up 3.7% in the past year. And of course, consumer spending is big for the GDP. So that's good, as long as they have the income to spend that, that's for sure. Within spending, the strongest contributor to growth in August was durable goods, which rose 0.7% to cars and recreational vehicles. The biggest source of weakness in spending came from non-durable goods, which fell 0.2% due to lower costs for energy. Oh no! Spending's declining! That's because energy prices have gone down. Thank you, George Mitchell. Thank you, fossil fuels. We're all going to die. Shh, shh. Don't tell Pablo. But if you eat carrots, you will die. Did you know that? If you eat carrots, you will die. It's proven. If you eat carrots, you will die. Let's see. It's also important to note that in spite of the small gain in August, spending has been accelerating recently, up at 6.3% annualized rate over the past 6 months versus a gain of 3.7% over the past year. So the last 6 months, we've seen a pretty significant increase in spending versus the whole year. No, please, no. Pablo's trying to eat a wire. Let's not do that, buddy. We don't have anyone get electrocuted. That said, we still think this is not the type of data that supports further rate cuts or cries that we are staring down a recession. That said, we still think that one more rate cut from the Fed is likely this year. The greater concern has been inflation, which continues to run below its 2% target. PCE prices was that producer consumer expense? I forgot. I can't remember. PCE producer something, whatever. Personal consumption expenditures prices were unchanged in August and are up 1.4% in the last year. So personal consumption expenditures are up 1.4%, while core price was it PCE? I forgot. We're up while core prices, which exclude the volatile food and core energy, rose 0.1%, but are up slightly faster. 1.8%. So we're seeing a personal consumption. The prices on personal consumption is up 1.4% in the past year. But if you exclude volatile food and energy, it's 1.8% in the last 12 months, which is pretty doggone close to the inflation target of 2%. However, the past months, both measures are on the rise. The overall PCE price is up at a 1.6% annualized rate, while core prices are up 2.5% annualized. In other words, inflation is moving towards the target and is already there under the more reliable core measures. Unfortunately, today's data or any of the other strong data released since the last Fed meeting will probably do little to change its leanings towards cutting rates. Rate cut is not needed because there's no recession on the horizon and no need for government intervention. But that's not the point. The government likes to intervene. New orders for durable goods rose 0.2% in August, which beat the consensus, which is estimated a 1.1% decline. And the August gain falls to 1.8% in June and 2% in July. Over the past 3 months, durable orders are up a strong 17.2% over an annualized year, but remain down 3% for the past year. So again, towards we have come out of a slumber, if you will, Maybe we're hibernating, but it looks like over the last 3 months, the economy is roaring back nicely. So again, recessions, just more proof recession numbers are silly. We're not going into one, and it's all good. It's arguably the most important number of today's report. Core shipments of non-defense capital goods, ex-aircraft, a key input for business investment and the calculation of GDP, rose 0.4%. But if unchanged in September, we'll be down 0.8% annualized. That said, we don't expect this measure to be unchanged in September, but rather to move higher. Orders for core capital goods, a proxy for business investment, are up a healthy 3%. Analyzed over the past 3 months, as these orders flow to shipments, we will see a turn towards the trend seen in 2018, which posted the fastest full-year growth rate in core shipments since 2012. Today's report adds to the litany of data suggesting the Fed has no reason for a rate cut. In fact, the fundamentals suggest rates should be moving higher. But again, we're not in a recessionary time frame. If anything, we've dodged any kind of recessionary bullet, and we're now back to growing the economy, which will certainly help somebody get reelected and keep the naysayers at bay, which means more impeachment drama to come. All right, we'll see you.